So, Gunjan, by my back of the envelope, American consumers were at least 30 days behind on their bills for almost $650 billion worth of debt as of the end of last year.
$600 billion. That
With
sounds
a B.
With a B. That sounds like a big deal, given that consumers are supposed to power the U.S. economy.
Yeah, and our guest this week will help us walk through the indicators about consumers, things that we should or maybe shouldn't be worried about, and what it means for not just our pocketbooks, but our portfolios, because all of this is going to be really important for investors. Hey everyone, this is Telis Demos. I write for the Wall Street Journal's Heard on the Street. And this is WSJ's Take on the Week, the weekly show where we give you a leg up on the worlds of money and investing. Each week, we bring you conversations with insiders and from inside the Wall Street Journal's newsroom about, well, the wild, wild west that is the stock, the bond, and the everything markets. Gunjan Banerji, welcome back.
Good to be here.
You picked quite a week to return.
It's been fun. I got back and all of a sudden I'm on limit up, limit down watch for the S&P 500 every day.
That's quite a state of affairs. Okay, well, why are you in that state of affairs? Let's just recap very quickly. President Trump, in the middle of this week, announced that he was going to put a 90-day pause on what he calls the reciprocal tariff regime. Tariffs are not over by any means. We're recording this on Thursday, the day after the markets had an enormous rally. I mean, a really historic one. We're talking the best day for stocks since, 2008, 2001, which I don't know if those dates are comforting or not. Those were, that's the middle of the 2008, the middle of the global financial crisis, 2001, kind of the aftermath of the dot-com bubble bursting. But here we are. Gunjan, where does that leave us? Are we done with the volatility or more to come?
It has been just a dizzying stretch for global financial markets. I certainly don't remember a time like this. It feels even crazier than March 2020 in some respects because that was over just so quickly. And I think it's really important to note that this time does feel different to a lot of investors, even though we got this 90-day pause. I think you're seeing that in the market action later this week, where a lot of investors are still thinking, we have this 90-day pause, but we are not in the clear yet. We still have tariffs on China. We seem locked in a trade war with China. And this seems like a new regime for financial markets, at least in the U.S. And I think it's leading a lot of people to think twice right now about buying the stock market dip. What we've seen is that
that's been the rule for years.
The
That's
hot
worked
trade.
for you again and again. After 2008, after the COVID pandemic, like that worked.
It's really been a reliable trade. We've seen people pile into the market on every small dip. What's happening now is that you jump in, and we have seen a lot of individuals jump into the markets. We saw a record buying day during this turmoil. But what happened was they pounced in, they tried to buy the market dip, and then the market falls another 6%. So this is just a really dangerous market to try to time. What's startling is that there is some unease about America's standing in the world from a financial markets perspective. And we saw broad-based selling in American assets recently, right? People were dumping the dollar. People are dumping our government bonds. These are supposed to be the safest things on the planet.
Yeah,
So
our colleague John Sindru called it the sell everything American trade. We'll drop that link
alarming.
In the show notes. Everyone should read it. But that's correlations of everything. Everything is selling at the same time sometimes. And that's a very scary signal.
One misconception out there is that what's been going on in the stock market does not impact everyday Americans, right? It does not impact the economy. What do you think?
Well, look, I think a lot of people look at the situation and they say Wall Street is not the economy, right? Stocks are not the same thing as the economy. Obviously, there are linkages, but, not everybody owns stocks. How companies are doing, how people trade the stocks of companies is different from how companies are doing. I mean, we just talked last week about what to look for in earnings season. It's not the same thing as what's happening in the stock market. And then also, again, because this is a political situation, right? This is a vision for how the American economy should work that ultimately, gets to politics. Maybe Wall Street doesn't get a vote. Right? Maybe the stock market shouldn't have a say over what we do. I mean, if the situation were reversed and a Democratic president were trying to do something, that appealed to their base, when Wall Street was falling, maybe the opposite people would be saying, "Oh, who cares what the stock market is doing?" That said, I think that in this case, this is a situation where what Wall Street is looking at is the likelihood of an economic crash. This is not yet a financial crisis. This isn't about people sort of positioning ahead of like, okay, where they think this piece of liquidity, that piece of liquidity. I mean, really, at the heart of it is an economic question. And so I think that there are reasons to look at what's happening on Wall Street as a lens on what people think is going to be happening with the economy.
I think that a market crash can impact the economy, right? If people don't feel as wealthy in their portfolios. And by the way, it's not just the wealthy in the stock market. Millions of Americans have 401ks that are tied to the stock market. They may be less likely to spend, right? And that affects the whole economy.
In the middle of all of this, we also have a pretty intense U.S. budget conversation going on, right? There's some infighting within, the Republican Party between people who think that the cuts should be deeper and the people who, think that maybe that tariffs will bring in so much revenue that we don't need to cut as much out of the budget. So in the middle of all this, there's a real debate about the U.S.'s kind of fiscal situation, which of course plays into the Treasury. So you throw all of that into this like cauldron, and you have a very just kind of unnerving situation developing where, there's really not something that people can turn to and say, okay, here's my point on the horizon where I'm going to look when there's turbulence and feel better about things.
That reminds me of something we touched on this week in this Q&A that I did with Wall Street Journal subscribers. And one of the questions that I got the most was, we've seen trillions of dollars of stock market wealth just evaporate within a week. Where's all that money going? Where are people hiding out? And during this Treasury mayhem, during everything going on, I think one place that people really are seeking safety in is in cash. We have seen assets in money market funds. These are cash-like investments. They soared to more than $7 trillion. That is an all-time high in data going back to the 1970s. So a lot of people are saying, let me just sit here for now. This is bringing me a little bit less unease than being in the stock market. And that seems like where people are hiding out a little bit.
Some really interesting tariff-related questions during that chat in the Q&A. And, we've gone ahead and put a link to that in the show notes, again, so that people can refer back to that. And hopefully some of the readers' questions on that day are your questions, going forward. And so you'll get some peace of mind out of that, or at least some semblance of answers. And we'll be looking at some earnings reports coming up this week for more information, right? We're going to get a slew of lenders and regional banks. We're going to get even some luxury goods makers, right? And so LVMH, Hermes. We decided to go the route of looking at the American consumer, the borrower, the thing that has been the bedrock, the ballast of our economy again and again. And so even if what's coming next is very scary, if the American consumer is in a good place, well, maybe we'll muddle through it. If the American consumer is really precarious, if they're not going to do that well, not going to spend, they're not going to pay back their debts, well, look out below. So to talk about that, we called up Kris Kraus. He is a managing director and portfolio manager at Pimco, which is a gigantic investment firm. They are a fixed income and alternative asset manager. They buy lots of bonds that are made up of consumer loans.
Lots of bonds.
Lots of them. And so Kris and Pimco have a really unique perspective and insight on the economic state of our wallets as consumers. And so we get into a conversation with Kris about delinquency rates, mortgages, how people are prioritizing their debt payments, and more. And we're going to have that conversation after the break. Welcome back. Today, we have Kris Kraus with us in the studio. Kris is a managing director and portfolio manager at Pimco, one of the world's largest investment companies. He's one of the people overseeing Pimco's investments tied to consumer debt, auto loans, student loans, credit cards, you name it. When you pay back a loan, you might just be paying these guys back. So let's start. So Kris, welcome.
Thank you. Great to be here.
So let's start with what everyone's talking about all the time right now, tariffs. Economists seem to widely agree that higher import prices will be passed on to consumers in the form of higher prices in some way or another. That can be what you pay for your car, what you pay to renovate your house, what you pay at the grocery store. I've been writing that this is a risk to lenders. If people's budgets are stretched, they might have to start skipping debt payments or dial back on their borrowing. But tell us, Kris, what do you think will be going on with consumers? Do you think consumers will be able to cope with higher prices if that's what comes to pass?
Great question, and obviously one that many people in the marketplace are very focused on right now, given recent events. A number of things I would say. I think that the consumer is more than just sort of this monolith, right? There are different parts of the overall consumer. There are some that are in a relatively strong or very strong financial position, and for them, passing on increases in prices, whether that's for automobiles, whether that's for groceries, you would anticipate would have less of an impact on their household budget and therefore their repayment ability. At the other end of the spectrum, right, you have consumers that might be more sort of in a paycheck to paycheck type situation. They don't have the benefit of having assets in the way of perhaps owning a home or other types of tangible wealth. And so those consumers are certainly ones that could be much more vulnerable. And I think a lot of work that is being done today to really understand the impact from what's being proposed. Right, we have a situation where you can cut the numbers in different ways, and you may say, in general, you've got a 10 to 15%, for example, expense coming from consumers towards imported goods. But what we're spending a lot of time on is understanding sort of those second and third order effects, really trying to understand component parts. What does that mean for finished goods, and so that consumer, what are they ultimately going to potentially be feeling as a result?
So, like you said, there are some people who we talk about recession risk. There's some people who, in their lives, they're kind of always living in what feels to them like a recession. Maybe they're not working and things like that. But what is the sort of state or health of consumers, of those consumers, of people who are kind of making more money, doing well? Are consumers strong right now? Do they have the ability to absorb?
It's a good question. I mean, when you look at sort of events in markets or shocks to markets, right? If we compare where we are today to where we were going back to the global financial crisis, the starting conditions for consumers today much more favorable than where we were going back to sort of a 2007, 2008 time period. You had people who were, in the aggregate, much more overextended in terms of credit versus where we are today. So as I think about the starting conditions for consumers today, and again, this is a broad comment, people are in a pretty good spot. One way to think about it is you've got homeowners today that have a mortgage. Right? You're looking at a mortgage rate that's 4% or even below. So, and in many cases, even below 3%. And so as you've seen—
And those are fixed. That's not going to change.
Rate.
Whatever interest rates go to, you're locked into that.
This is a unique feature of the U.S. mortgage market. And so if you rewind, as the Federal Reserve was raising rates back in 2022, those individuals or those households that had that fixed rate 30-year mortgage, and my niece and others and some of us here, pretty low, you weren't seeing a change to sort of your sort of household income statement per se. In fact, in many cases, you were seeing an uplift in terms of any excess savings that you had. You were actually going to start earning money on that excess savings. And so, for many, they're in almost this positive carry trade where they're generating more return on their savings than they actually are on what they're having to pay on their mortgage. And so as we think about the path forward from here, you're hearing more talk of stagflation. You're hearing about potential more inflation in front of us. It's going to put a higher level of stress on that lower end.
The classic theory of inflation is that when people are expecting prices to rise, they spend more today, right? Because the price will be higher tomorrow. They save less. Do you worry now? The inflation that we saw, previous to this, right? The 21, 22, 23 stuff, like you said, didn't really hit the consumer that hard. The consumer's doing pretty well. Is there a risk that this time around, either because inflation expectations become more ingrained, maybe because the consumers already kind of, had to catch up to that prior inflation, is there a risk that this round of inflation plays out differently for consumers?
It's a good question. We tend to think of more of a K-shaped type of scenario in terms of you do have that
K-shaped, meaning you've got one.
You've got one going at one speed,
going this way, one going that way,
and you've got one
up and down.
One that, again, starting conditions pretty good, wages pretty good. They own assets. again, you may see them pull back in terms of spending, but I wouldn't anticipate a significant level of or an increase in delinquencies and defaults as it relates to that part of the sector.
Interesting.
So there's so much uncertainty out there about where the consumer goes. Seems like American consumers were super strong heading into this stretch. That could obviously change with these tariffs. What are kind of the key indicators that you watch? I feel like there's so many out there. There's a million data points to stay on top of. What's kind of the one thing that you look at the most?
We've got some upcoming announcements coming in terms of Q1 earnings, in terms of charge-off rates, what delinquency rates look like.
Those are from the big credit card
You've got the big
companies,
credit card
right?
issuers. Sort of
American
what are
Express,
they seeing?
Capital One,
Right,
Synchrony,
from
Ally.
Right,
those types.
exactly.
Okay.
And I think there too, they're likely still at elevated levels of charge-off, but year-over-year delinquency.
Define charge-off for us?
So basically, in the case of the consumer loan, they've tried to collect. The money isn't coming back. They essentially then write it off to zero. They'll on-sell it to a debt collector for low money, and then they'll try to hunt somebody down via mail and other services
Sounds
to
fun.
extract something. It's not exactly the most exotic business to be in, but it's there. And so they're charging off. They're writing these essentially to zero and saying we're not going to collect anymore. And so that's an indicator of credit performance from them. So we're certainly focused on that. We have our own data that we're looking at as well. More broadly, you're also looking at what is the demand for credit, right? Are consumers saying, well, okay, I may be okay in terms of my financial situation, but I'm not really feeling the need or the desire to take on a new form of indebtedness, whether that's to buy a new car, buy a new home improvement loan, or even just spend less money in terms of going out for dinner, buying clothes, those sorts of things. And so
that's interesting. So you actually look at wanting to take on more debt as sometimes a positive signal.
It's you want to understand, is everyone just going into sort of a state of retrenchment, in which case that's going to be a headwind for the economy, right? You're going to see that effect slow down. And that's why things like the survey data at University of Michigan and others
That's
are
the consumer
important.
sentiment.
Consumer
number we all
sentiment,
talk
how are
about, right?
people feeling?
I mean,
it's
that's been tanking recently, right?
It
Consumer sentiment.
It fell fairly sharply a few weeks ago. And so, as people are processing what's going on, and we put out a piece back in January titled "Uncertainty is Certain," because of what you were seeing in terms of potential policy coming from the administration, and making certain that you are prepared for potentially a wider distribution of outcomes.
Right now, investors are banking on 3-4 Federal Reserve interest rate cuts this year. Should they?
I think there's a case for that. We wrote in our latest cyclical outlook, and our CIO spoken about the case for 2 cuts later on in this year. I think everything's going to be dependent upon the impact from tariffs, the impact from the tax bill, how the economy reacts. Right, this is a big event. Right, it's a big event, and we need to see again, where does unemployment go? How does the consumer respond? So it's here we are in April. We still got plenty of months in front of us. So it's as we said, uncertainty is certain. The volatility is obviously here and will be here for a period of time for sure.
Given this K-shape you've talked about, where people who are doing well will kind of manage through this, people who are already struggling might get worse. Their situation might get worse. What do you think that means for the kind of economy and the sort of market picture overall? Does the market rely basically on the people who already have money to keep spending? I'm sure that they represent the vast bulk of spending, and already we've seen so much more spending for services than goods. So maybe this is something that we can kind of put in one box, or do you think that there is an economic fallout risk from what might happen to people who are going to fall further behind on their debts?
It's a good question. I mean, economic fallout, and we could take that in a number of directions. I wouldn't say that high-end consumer or that asset-rich consumer by themselves as a cohort can essentially lead the economy forward on its own. You want to make certain that businesses are doing well, that they're generating profit, that shareholders are generating returns. There is this incentive to invest, and that's how, right, you invest, you build businesses, the economy grows, there's an extension of credit. You want to make certain that those gears are functioning, right?
We can't save the economy just by spending more. Just going out and shopping by itself is not enough.
No, it's you want to make certain that the wider economy, again, the corporate piece is functioning. You need it all to work.
We're in the midst of kind of bank earnings season here.
Mm-hmm.
We've got a bunch of lenders' earnings coming up. American Express, Capital One.
Mm-hmm.
Those will play out over the next few weeks. Are we going to see? Do you think we'll see continued kind of loan growth
Mm-hmm.
from them, and that will be the most important thing to look at versus like whatever the delinquency numbers are? Because of course those are backwards looking.
Yeah.
What's to look for there?
You need to look at all of it in the sense of how is the existing stock of credit performing, right? As how stretched are households feeling, and you, for us at least, we want to look at different parts of the consumer complex, and you want to look importantly at different sort of FICO bands. As again, that sort of paycheck to paycheck end of it, whether that's in auto, whether that's in consumer installment, I would anticipate that you're going to continue to see some headwinds there, and they're just going to be in a more vulnerable position as a result of some of the policy decisions that have been taken. The upper end, again, we feel like they're in a pretty good spot overall. As you think though, just about sort of wider GDP growth, you do want to see that extension of credit, pulling through. And so I do think we're going to be in a period of time where you're going to have perhaps some mixed messages. You're going to see, I would anticipate, relatively okay data coming out in terms of probably declines in year-over-year delinquency rates, which would be a positive. You're probably going to see continued elevated levels of charge-offs in certain sectors, and that gets back to that credit box being pretty loose a couple years ago.
Yeah.
I would anticipate you're going to see some fairly cautious statements coming out of management teams.
Yeah.
Right. We've entered this period of uncertainty. Everyone's going to want to make certain that they're staying on top of the credit quality.
We're going to take a final break, and when we come back, we have one last question for Pimco's Kris Kraus. Are you expecting a recession this year?
We've increased our forecast for it, but it hasn't necessarily crossed the tipping point. We do think that you've
being
got
like 50% basically.
It's an ongoing
JP Morgan,
discussion.
I think their economists were saying 60% most recently,
Yep.
right?
So you've got obviously tariffs will serve as a headwind for the economy. I do think the tax bill that's being worked on, which seems to be gaining pace, will be supportive. Right, so you're going to have some competing forces working through the economy for sure.
Thank you, Kris. This has been great.
Yeah, thanks for
Appreciate
joining
it.
us.
Thank you. Good to be here.
So one thing our audience should know, we are going to take a break next week, and we'll be back with a new episode on April 27th.
So these are going to be, we're going to ask you like a couple of
Rapid fire.
rapid fire
Rapid
questions,
fire.
but
Oh,
It's like a pop quiz. So in 30 seconds or less, what do you...
I'm looking at your watch. 30 seconds.
I'm timing you.
Yes, I'm asking the question, he's timing you.